30, 18 contracts of this one. This is a so-called call option, which means I bought the right to buy at $30 on or before 17th January 2025. And I paid about, currently it's trading at $13.23, and I paid $132 per share. I'm betting that it's going to be above $30 in 2 years. If in 2 years, and I still own this option, AI trades at $40, I have a right to buy it at 30. I'm going to buy it at 30, I can sell it in the market for 40, make money. If it's below 30, I'm not stupid, I'm not going to buy it. Of course, these things fluctuate. I mean, I bought it at 132, but if this stock goes to $20 tomorrow, it won't. But if it does, the value of this option probably is going to be about $5. So I can buy it at 132, sell it at 5. Thank you very much. Even though we haven't reached 30 yet. But if tomorrow it goes down to 10, this option probably goes down to about 80 cents a minute. So, just like any powerful weapon, when it works for you, you make a lot of money. When it doesn't, you lose a lot. But to me, this is a leverage bet. The total amount of money I put is less than $2,500. But I'm actually controlling about 3,000 shares. Well, I'm sorry, 1,800 shares. Again, the underlying price AI, but value of this option depends upon what the underlying is, among other things. There are many other derivative securities. Examples. Interest rate swaps. These are contracts that exchange fixed and variable interest payments. It can be used to speculate about interest rates and or hedge interest rate exposure. It's very common in Europe, for example, when a corporation borrows from the market, they borrow at what we call floating rate. Typically, it's some sort of reference rate plus credit spread. So if you borrow at LIBOR plus 2, LIBOR being short for London Interbank Offered Rate, it's similar to prime rate if you think about it. It's given to the customers that has almost no default risk. And depending upon your credit score, if you will, you pay something about it. Think of yourself who borrowed some money 2 years ago at LIBOR plus 2. 2 years ago, LIBOR for, let's say, 6 months was about maybe 0.5%. Now it's over 4%. So your interest payments went from 2.5% to over 6%. That's obviously a risk. And you didn't want to take that risk, so what could you have done? What could you have done is enter into a swap contract. You find a counterparty who's willing to pay variable rate for whatever their reasons, but they act. So they pay you fixed rate, they pay you the floating rate, and you pay them a fixed rate. Since your other exposure is also floating, net fixed, that other guy turned his fixed exposure into float. That may have been what he wanted in the first place. Or they did it for speculation purposes, or they had lent money on a floating rate basis, and they didn't want to take that risk. They wanted to make it fixed. They had lent money on a fixed rate basis, but they may be betting that interest rates are going to go up, so they wanted to convert it into floating. You can also do things like credit default swaps. Have you guys ever heard about these? If you watch the movie Margin Call or Big Short, you may have heard about them. These are basically instruments that allow you to insure against default or bet that somebody's not going to default. Let's say I bought bonds of Netflix. For the next 10 years, I expect to make a certain interest, plus 10 years from now, I want to get my money back. But I'm concerned that Netflix as a streaming business may not be what it was 5 years ago. And I want to protect myself against possible default. So I'm going to go to market, and Gary, for example, Gary says, okay, I will sell you default insurance. And typically these swaps are for periods of 5 years. Over the next 5 years, if Netflix defaults on its bonds, I'm going to give him the bonds and he's going to make me whole. So let's say I bought $10 million worth of bonds. He will pay me $10 million. I'm going to give him the bonds. His problem is with Netflix. Of course, he's not doing this because he's a charity. He needs to get something for that. For that privilege, just like I pay premium for insurance, I'm going to premium for default risk protection. And that's the credit default swap. Let's say 2% a year. So every year I'm going to pay him $200,000. These are more common for so-called sovereign bonds. For example, let's look at some that CD is not certificate of deposit. For example, currently for Turkey, that rate is 557 basis points. That means for each $10 million of protection, the buyer of the credit swap is going to have to pay $557,000 a year. On the other hand, the same rate for Brazil is only 238. Down under 27. That's Russia. I mean, you actually have to pay $13,775,000. That's kind of apparent, but Egypt 542, China 53, Spain 47, Portugal 38, Greece 92, and so on and so forth. Back in early 2000, Greek credit swaps were around over 1,000 basis points. Remember, 1 basis point is 1% of a percent. So 1,000 means 10%. And we'll talk about how to price those as well.
It's 10 million the same.
Huh?
It's 10 million.
No, I'm
Just like that.
so that I can convert those basis points into thousands. Typically, default quantity is $1 million. We will also talk about something like asset-backed securities. These are kind of generally of financial engineering. You guys have heard mortgage-backed securities before? And typically, when a mortgage is originated, these days, a bank rarely keeps that in their books. They sell it to a pooler, and if the mortgage is qualified for federal pools, you need at least, I think, 640 in credit score, income to debt service to income should be below 40, so on and so forth. They can actually sell it to either Freddie Mac or Ginnie Mae. Those guys pool those mortgages, and they issue a bond backed by those mortgages. In fact, if it's federal, they're also protected against default. It kind of allows individual investors to basically do mortgages in small amounts. Let's say you pull together $100,000 mortgages, that's $100 million. You issue a bond, let's say each bond is $1,000 worth. You buy one of them, you effectively loan somebody $1,000, and they're going to make you payments for the next 30 years. That's it.